Tax season is in full swing, and the tax planning strategies that we implemented with our clients back in the fall are on full display. One in particular for retirees can help them withdraw up to $48,000 tax-free from their retirement account. Make sure you take advantage of this. I got that story and more coming up. We all know that if you have income, then it is required that you file an accurate tax return by the deadline, which is April 15. If you have income, it's not an option. You have to file your tax return. Hopefully you're getting a refund. Hopefully there are no surprises. However, tax planning is not required. Tax planning, that is the proactive, that is the in advance, that's the creative ways of determining, well, what opportunities are at your disposal to pay the least amount of tax over your lifetimes. A lot of time, that means trying to pay as little tax as possible this year, getting the most deductions, optimizing your tax picture. But sometimes it does mean inviting some income into this year so that you can avoid paying taxes out there in the future. If you don't prepare your taxes by April 15, do you get in trouble? Yeah, it's a problem. It's required. There are penalties and late filing and all that sort of stuff. If you have income, you got to file. Well, if you don't do any tax planning, are you in trouble? No. There's no issue. There's no problem. And in fact, you probably don't even know that you missed out on opportunities. But here's the thing. The tax planning work, that's the creative side where you can save thousands, if not tens of thousands of dollars in taxes over your lifetime, if not multiple lifetimes. There's one strategy specifically for retirees that influenced a lot of our planning in the fall last year. And as we're preparing taxes and meeting with these folks this year, it's really creating a lot of high five moments. And one in particular, I just met with a client just the other day, and I want to tell you about it. So here's the situation. This is a recently retired couple. They are in their late 60s, 67, I believe, and 66, or similar age. And they moved last year, which means they've got a little bit of a mortgage because, of course, moving's expensive. Houses are expensive. So they've got a mortgage around $120,000, and they're working on paying that down. Well, during their career, they were in the 25% and 28% tax brackets with their income, okay? And yet in retirement, since they've been retired, living on their pensions, their Social Securities, and some withdrawals from their IRAs, they are in the 12% tax bracket. Guys, it's a beautiful thing. They made contributions in their retirement plans during their career and deferred 25 and 28% taxes. And now as we're drawing it out, we're paying 12%. It's fantastic. In fact, there's a little bit of room every single year that we can withdraw extra from their IRA and fill up that 12% tax bracket. And that's what we've been doing. Now that they've got a mortgage, the plan, hey, we're going to do that, and that's how you're going to make chunks down on your mortgage as long as you don't need it for lifestyle. So that's the strategy. That's what we've been doing. They qualify for the new senior deduction. In order to qualify for this new deduction, you've got to be age 65 or older, and your modified adjusted gross income needs to be below a certain threshold. For married filing jointly, that's this couple's situation, needs to be below $150,000. If you're above that, then you start getting some of it reduced. It's phased out until your income's, above a certain level, and then you don't get any of it anymore. Well, they are right below that $150,000 adjusted gross income limit. Therefore, they qualify for this new senior deduction. Therefore, when we did their tax planning this past year and we were analyzing, all right, well, how much extra could we draw out of your IRA to fill up that 12% tax bracket? We were able to withdraw an extra $12,000, essentially tax-free from the federal government. When we prepared their taxes just recently, yeah, it all worked like a charm. We withdrew an extra $12,000 last year, in addition to the rest of the dollars that we withdrew to fill up the 12% tax bracket. We then withdrew another 12 grand that essentially was neutralized completely because they maximized that full $12,000 senior deduction. $6,000 for him, $6,000 for her, $12,000 in total. It allowed them to get an extra $12,000 out of their retirement accounts that, again, when they made the contribution to their retirement accounts, their 403Bs and their 401k, they were able to deduct or get a deduction on that contribution of 28% or 25%. Now they're drawing it out, 12 grand of it, completely tax-free at the federal side. Yeah, they've got to pay state taxes about 5%, but we did that last year. We did that in the fall of 2025. We already, guys, did that in 2026. We already withdrew this extra chunk of dollars that we know will be tax-free. We'll ensure that they qualify this year, and they've already put that chunk on the mortgage. So that's 24 grand that we've already withdrawn from their retirement accounts that will be tax-free. We're going to do it again in 2027 and 2028 before likely that rule is going to change and this deduction will go away unless Congress acts to extend it. So whether this applies to you or for your folks, if you say, I'm not age 65 or older, this really doesn't apply to me, well, it's possible that your folks have some dollars in IRAs that have deferred taxes. Someone's going to have to pay tax on those dollars. The question is, at what rate? And right now, with this new tax deduction, a lot of seniors are simply just getting the deduction without optimizing it. And yes, it reduced the tax on their Social Security, or maybe it reduced the tax on their interest income. However, instead, I would want to leverage, can you withdraw some dollars out of your IRA, out of your pre-tax accounts, and avoid taxes on that income at the federal level? Make sure you're optimizing that. More importantly, make sure you're doing the proactive tax planning work with your certified financial planner, looking at all 6 areas of your financial life, determining what opportunities exist for you to pay the least amount of tax over your lifetime. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.